And last week we had some in the chat, people anticipating your appearance on the show, with some Yale jokes, some Harvard jokes, and but I got to start your Yale Bulldogs, the big upset over Auburn in the big dance. The Ivy League has just been kicking butt in the tournament lately.
Yeah, I gotta say that was a thrill, and doubly thrilling for me because our daughter is there now, so she got to experience it as an undergrad. When I was there, the hockey team was really good, and the basketball wasn't much good, and she gets to see some really high level basketball, and always fun to upset an opponent who's ranked much higher than you are. So that was really fun.
Yeah, I mean that Auburn team going into the tournament was one of like the the chic picks to make the Final Four, and yeah, Yale took care of them quickly, and Princeton went to the Sweet 16 the year before, if I'm not mistaken. So
Yeah, back to the days of the four corners before the shot clock, right? When they used to score 24 points a game and still win.
oh man, too funny, too funny. So all right, well, let's go ahead and get started. This is the big picture. I'm Rich Swerbinsky with Onward and Upward Consulting. My esteemed colleague and co-host Rob Krisman, unable to make it today. Rob, yeah, Bob and I were just lamenting. There is some board of directors that has accepted Rob as a member that he's sitting on. He could bop into the show, you know, Rob. You never know when he may bop in, but at least at the outset, no Rob today. But very pleased to introduce very special guest this week, the president of the Mortgage Bankers Association and CEO, Bob Broeksmit. Bob, thanks for being with us.
It's great to be with you, Rich. And I think one of the most oxymoronic phrases in the world is Rob Chrisman board member. So we'll see what company might that be.
Keeping with the tenor of this show and keeping it light. Love it, Bob. And busy times for you. We are talking a little bit about it before we started to go live. Just so much going on in housing now. And of course, MBA secondary next week. When does the president and CEO of MBA, do you have to go out there like days in advance? Do you roll in Sunday morning? Yeah, when does the prez roll into Times Square?
I do roll in Sunday morning by train, and I remember a hellish cab ride for the I don't know, mile and a half from Penn Station to the hotel last year, and sure enough, they're having the same parade. The streets will be blocked, so it'll be an exciting entrance to the Marriott there. But we're really looking forward to the conference. We have a great slate of guests, including Margaret Brennan from CBS's Face the Nation, one of the premier Sunday morning talk shows. So she'll be, of course, up to the second on all things political and governmental. And then from the regulatory side, we're really happy to have Philip Jefferson, who's the vice chair of the Federal Reserve, will be addressing us, as will Sam Valverde, who's acting president of Ginnie Mae in the wake of Alanna McCargo's leaving there to go run the Federal Home Loan Bank of San Francisco. And we're really delighted to have acting HUD Secretary Adrian Todman addressing us, as well as Rohit Chopra, who I hope will take a few tough questions from me. I know he's going to address us, but he'll usually take some questions. One of the things that you hear me be a vocal critic of his and of the agency, but he likes to mix it up. So I'm hoping that'll be kind of a spicy session.
I've seen you and Director Chopra mix it up before at this conference. Actually, I think it was a couple years ago, where it was you certainly didn't pull any punches, and yeah, to your point, he I think enjoyed the back and forth. Certainly a man of conviction, and that'll be interesting. So lots of big lineup of speakers and names and keynotes for MBA secondary in Times Square, New York, coming up starting on Sunday, of course. And it's been, how many years in a row has secondary been? It's been what, at least 25, I want to say.
Well, we used to move it around like we do our other conferences. And then a long time ago, I'm not sure exactly when, we said, well, geez, it's kind of the epicenter of the capital markets. And and people like to go to New York. We get some complaints about Times Square, which is, not the jewel of New York City, unless you're a wide-eyed tourist looking at all the neon lights, and then you're me sort of huffing and puffing and saying, quit blocking the sidewalk. I got a place to go. But it is a good central location, and certainly right there on Broadway. A lot of members do take advantage of the location and bring a spouse or extend the trip and take in a play or something. So we always look forward to it, and it's there's a lot going on, as you know, that affects our business, and having Vice Chairman Jefferson from the Fed address this directly, I think is going to be really interesting.
If you're a first timer, don't take any pictures with any of the people dressed up as cartoon characters. Just a little, little.
Yeah, I think bad things happen when you do that.
They'll just start following you until you give them $50. Really, basically, is how that works.
The lids come off those costumes and reveal sort of unsavory people underneath.
Really, yeah. I mean, I've seen a couple times where, like, one of the characters has just removed their headgear, like, and with no care in the world, in front of, like, a 6-year-old kid, who just starts sobbing as they see, somebody just counting 20s out of their pocket, taking the headgear off. So too funny. The chat is activated today. If anybody has questions for Bob, go ahead and feel free to put them in the chat or the Q&A, and we can work on incorporating that into the show. And let's start, Bob, with the news that just broke. We were kind of talking about it pre-open, but the Supreme Court came out today and ruled formally that the CFPB's funding structure is legal. This is something that's been batted around in the courts for some time. And your thoughts on the breaking news today.
So this is a little bit more of a complex issue than it might seem at the surface, because you would think that MBA would do everything in its power to abolish the CFPB, right? Because we disagree with them all the time about where their authority stops and starts, whether they ought to regulate by blog post or by actual rulemaking. And I think you can tell by the way I said that, we think they should regulate by rulemaking, not by regulation by enforcement or blog posts. And the list goes on. However, if the Supreme Court were to have found that the funding source of the Bureau were unconstitutional, and therefore, since it's had the same funding source since its inception, everything the Bureau ever did gets undone, that would cause chaos in our business. And I'll give you a couple examples. The Dodd-Frank law mandated that a rule be written about qualified mortgages and the ability to repay. The actual statute, which is what you'd go back to if the Bureau were found to be unconstitutional, does not provide the definition for QM, which we as an industry worked closely with the Bureau to settle on, nor does it provide a safe harbor that if you follow certain steps, you have met the ability to repay threshold. So if the court had found differently, it could have really upset the mortgage market in ways that I'm not sure everybody really understands. So what we did is we wrote an amicus brief, which we submitted to the Supreme Court, that said, look, we don't have a view on the constitutional question. That's for you all to decide whether the funding source is constitutional. But if you do determine that it's not constitutional, you've got to give an alternative other than just undoing everything the Bureau ever did. So they never got to that point because they decided by a 7-2 vote, pretty resounding, that the funding source is constitutional. And I don't know if anybody cares, but the funding source is a direct draw from the Federal Reserve rather than an annual appropriations process, which was meant to insulate the Bureau from the political wins. Frankly, since the director serves at the pleasure of the president, it does swing back and forth as the presidency changes, but at least they're not subject to annual appropriations battles with the Congress. And the court found that since Congress mandated that the funding come from the Fed, that in effect is an appropriations process, even though it doesn't go through the annual process in the Congress. So that's where we are. And what it means is no change to the mortgage process, but it will get some court cases going again that had been stalled pending this decision.
Interesting. Yeah, because you're right. I mean, if it were to be I mean, that would just create complete chaos throughout the mortgage. I mean, I think more than, the perceived, inconvenience of what the CFPB kind of levies on the industry through regulation and rulemaking. But
Right.
it's a, very valid point. And I wasn't fully aware of that, honestly. So it's something good to know. And I guess it's good then that the CFPB and the ruling went that way this morning, then from at least from your perspective, because I mean, right now there's so much going on that I'm sure you didn't need that lumped onto the top of the heap.
Well, precisely right. I mean, and think about TRID too. I don't think anybody loved going through all the implementation stuff for TRID a few years back. But now that we've spent all the money and are used to it, I don't think you'd want to go back to the statute, which doesn't have TRID. TRID was a rule, not in the statute. So that's another example of something that would have been undone. And to take away the QM and ability to repay safe harbor would have pulled the rug out from under investors who rely on that, because as you know, the defense, a failure of TRID or ability to repay gives the borrower defense to foreclosure. And what's an investor going to say if now they have a whole portfolio of mortgages where if the borrower goes delinquent, they could say, well, you can't foreclose on me because the ability to repay safe harbor doesn't exist because the Bureau did that and the Bureau is unconstitutional. So anyway, I know it seems perverse for the MBA to say that a better outcome is for this to have been declared constitutional because of the chaos that would ensue, but that's where we are. And I think the industry ultimately will be grateful that we did not go back to these really unworkable statutes that came out in Dodd-Frank.
Is turning our attention, Bob, FHFA right now there's a comment period open, weighing a proposal from Freddie Mac to potentially buy second mortgages up to 80%. It's created just a lot of discussion, I guess, in the industry. People that are interested, in favor, maybe not in favor. Their comment period is still open, I believe, for another 5 or 6 days. And then I think FHFA has 30 days to render some sort of decision. But I'm sure you've been following this and didn't know if you had any thoughts on this initiative. And it's got to be kind of a double-edged sword, because it would be good for mortgage lenders at a time where they really, really need a little wind at their back. At the same time, there may be some unintended consequences from something like this that could impact our industry. So your thoughts on that?
Yeah, Rich, this is a really interesting issue from a whole lot of angles. One of them is that this is the first new activity that is going through a process at FHFA that was made final in a rule, I think last year, that says, look, if the agencies want to do something they're not currently doing, and generally there might be a question as to whether it comports with their charter, for instance, then it has to go through this process where there's a public comment period, which, as you rightly say, we're getting toward the end of it, ends next week. And then there's a set process within FHFA and a deadline to say yay or nay. So this is the first time, so it's a really important test case. And you also rightly say that there is strong interest in this from lenders because, let's face it, if you want to access some of your equity, and we have record levels of home equity in this country, if you want to access some of it, a cash out refi probably isn't the most effective way, depending on how much cash you want out and how much you own your house. But if you owe 3% on 300,000 and you want 50,000 out, refine into 6.5 at 350, that probably doesn't pencil out very well. So if you keep the 300 and you get a second mortgage for 50, that might be a pretty appealing prospect to borrowers. And as you rightly say, our lenders, God knows we need the volume. The question, I think, comes down to, does the private market, mostly banks, some IMBs with securitization outlets on Wall Street, does the private market already adequately serve this need? I think that's where you'll find disagreement among different players. We've had some very large IMBs recently who one of whom in particular is very active in securitizing, say, no, we think this is a good idea. So we had a webinar last week on this issue with Freddie Mac and a lot of our members, and we raised a lot of questions for Freddie Mac, which they hadn't fully thought out. So our comment letter will raise those questions, suggest what we think are appropriate answers for it, but probably not be a completely, we're 100% for this or we're 100% against it, reflecting the fact that there are legitimate questions about whether this is the GSEs disintermediating the private market with subsidized public money, or whether this is, as I mentioned before, a really efficient and effective way for millions of Americans to tap their equity and to use the full panoply of mortgage lenders out there to get that done. So stay tuned. We'll have the final comment letter next week, and I will just also mention that as it's proposed, I don't think we're going to have a lot of concerns about credit risk with the GSEs because they are proposing only an 80% CLTV, and of course you can get a 80% first mortgage from the GSEs without mortgage insurance. And they also are proposing that these loans only be behind existing Freddie Mac first. So you're talking an 80 CLTV where Freddie would have the risk on the first and second, and who knows, they may use credit risk transfer to help lay off some of the risk. They may have already laid off some of the risk on the first. So I don't think we're going to have a big safety and soundness concern on this as much as some things we want to make sure get spelled out correctly.
It's impossible to know, but it's a Freddie Mac proposal. But one would leave one to wonder. If approved, you'd have a lot of people out there with Fannie and Ginnie loans. Like, what the hell? I want my 50 grand, and I want to leave my 300K alone. Do you think this is something that, if approved, would be implemented, through with Fannie and Ginnie as well, or maybe just Fannie, or it's probably hard to speculate?
I think that Fannie would quickly follow suit, is my impression. I think it would be a perverse outcome if, I know their market share is not exactly half and half, but let's say half of the GSE market could avail itself of a second and the other half couldn't. I don't think that would last for long. So I think Fannie would follow suit if this were approved. Ginnie, as you know, already goes up to a much higher LTV. So if we're talking 80 CLTV, I'm not sure that it would really apply to Ginnie. And I think that to the extent somebody either made a bigger down payment or has had the loan a while and has some equity, I think those borrowers could probably be served by banks if they had the equity to access.
Yeah, that makes sense. The comment period is open. Would implore everybody to weigh in with your opinion, whatever it is, on this, because one of the things that Rob and I always talk about, Bob, is just how lucky we are to have the MBA under your leadership. It is really startling to me, many, many years being in this industry, that how little DC understands our business at times, and decisions that they go down the road of trying to make maybe before comment periods open, or maybe decisions that end up getting put through. So important to have a voice representing us as mortgage lenders across America. And I want to give you this time to, people that are listening to this live, or will listen to this after the fact on podcast or YouTube. What is ways to get involved, right? You can attend the MBA secondary conference. You can comment when comment periods are open. But what are some, just Joe mortgage banker that is maybe concerned about some things going on in Washington, a way to make their voice heard and be part of the solution?
That's a great question, Rich. And I think a lot of mortgage lenders and mortgage servicers underestimate their importance. And what I mean by that is, when we have our National Advocacy Conference, which we just had in March here in DC, and we have we had about 400 people come. We had over 250 different Hill offices visited. And when they hear directly from people in their districts or in their states, if they're senators, the economic impact that the company that you represent, whoever you work for, has, the number of people you employ, the number of loans you make in their district, the economic impact you have, they sit up and take notice. And it doesn't matter what party they're in. I think there's this, what I consider false narrative that while things are definitely partisan in Washington, things like housing and housing finance, everybody cares about. There are some issues that if you, I mean, frankly, if you're going in and advocating on a really controversial topic that splits, all Republicans are for and all Democrats are against, you got a much tougher row to hoe. But when you're talking about housing, everybody's interested. And the thing that I think makes the most difference, and that some of our more successful members do, is to go and see their congresspeople and senators in their district offices. So I'm inside the Beltway. I've lived here a long time, and I know that the House is in session Tuesday through Thursday, maybe an average of 3 weeks a month. There's a recess for everything you can imagine under the sun, and the Senate the same way. And the rest of the time, they're back in their districts or back in their states, and they have district offices. They aren't getting interrupted to go vote on the floor, and they can actually spend a little time with you, get to know you, and understand what you do in their districts and why your issues are important to their constituents. And it all comes down to that. We're the hired help. We represent you as well as we can in Washington, and we have great relationships, but nothing matches the constituent coming in and saying, here's why this issue matters and here's why we need support. And that's what we've done on this trigger leads bill. And we've got dozens of sponsors in both houses and in both parties, and it really works.
This is The Big Picture. I'm Rich Swerbinsky with Upward Consulting, joined this week by the president and CEO of MBA, Bob Broeksmit. And Bob, yeah, you mentioned it, turning our attention to some more positive news. You mentioned the trigger lead bill, good progress there. And then also, I know MBA has been fighting really hard working with the GSEs, just things like a better uniformity between Fannie and Freddie, repurchase requests on loans that are performing. I saw there was some positive updates along those lines. And yeah, if you could just give us an update on the trigger lead bill and maybe some of the initiatives that I mentioned with Fannie and Freddie.
Sure. So on trigger leads, just I expect most listeners get it, but I'll just very briefly say that when a borrower gets a credit report in conjunction with a mortgage application, the credit bureaus, some of them sell those leads, and that means that a prospective borrower that you've just pulled a credit report on may get 75 to 150 texts, emails, cell phone calls from others. They are permitted to do that by the credit laws only if they offer a bona fide offer of credit. We know from firsthand experience that they're not doing that, but nobody's policing them. So rather than trying to get somebody to police them, we've gone the legislative route and said, look, the idea of this is to give borrowers choices. The effect of this is that borrowers are harassed. They have calls that are impersonating the actual lender. They have calls that are misleading them, and it's unhelpful and it should stop. Now, there's common sense carve-outs for if the borrower can opt in to allow trigger leads to the entity that originated their loan, the entity that services their loan, and any entity with which they have a depository relationship. So if they have a checking account with a bank, that bank could also, if they choose to, buy the lead and call them, because at least those entities have relationships. They know the borrower, and they can go over perhaps any other competing offers that they might want to make. So that's what the bill is. It's evolved to that point. We now have the same language in the House and the Senate. We have, as I mentioned, dozens of bipartisan sponsors, and we are frankly looking for a moving vehicle, or perhaps if we get some more sponsors, unanimous consent so that it can kind of pass without going through all the committees. But stay tuned. We're working this issue very hard. I was just on the Hill week before last, meeting with Patrick McHenry, the chair of the House Financial Services Committee, and Richie Torres, who's the Democratic sponsor of the bill in the House, strategizing for how to get this done. So we're optimistic and continue to ask our members to use the Mortgage Action Alliance. We have a call to action out there, which is an easy way for you to have an email sent to your representative and senators urging them to support the bill. Now, on Fannie and Freddie and repurchases, this has been a little bit of a passion project of mine. I've been at it for quite a while, both with FHFA and directly with the agencies. I've spoken directly to Fannie Mae's board of directors and CEO and chairman on this, as well as the most senior levels at Freddie and Director Thompson directly. And that has all led to a really interesting pilot at Freddie Mac that I think about 15 of our members are involved in. They are looking at a quarter's worth of originations, and depending on the quality score, there's something called an NAQ. I think it stands for net asset, or non-acceptable, I forget, NAQ. It's a quality control term of art. And if your score is good, even if they found a loan that had a problem, if the loan's performing, you wouldn't have to buy it back. If your score were a little worse, you could pay a very modest fee, and I mean tenths of a basis point. So not 10 basis points, but tenths of a basis point on your production from that quarter, and then not have to buy the loan back. So it's a really, I think, good faith attempt by Freddie to say, look, the quality control process, as we've been doing it for years, is really not the most effective way to do this. We want to incent quality. We understand what a hardship is to put loans back to our lenders when our research shows IMBs, generally speaking, have lost money 8 quarters in a row. And P.S., Freddie Mac stops making money on the guarantee fee if they put the loan back. So it's in everybody's interest to reform this process. We're hoping to get results from this pilot soon. And then Freddie can go back to FHFA and ask for permission to make it available to every lender. Or, I mean, if it doesn't work well, I guess there'd be a different result. But we hope and expect that they would then be able to ask FHFA to let them offer it to every lender. And, you know, as is often the case, if one GSE does it, I mean, I'd be shocked if Fannie didn't. They might not look exactly the same, but if Fannie didn't also do something to say, look, we can quibble about whether there's a problem with this appraisal or whether you verified the right income or whatever it is. But after all, underwriting is really just a prediction of whether the borrower can make the payments. So if the proof is in the pudding and the borrower is making the payments, even though we have a defect, let's figure out a way to keep that loan in our portfolio and not put it back to the lender.
Outstanding updates, and thanks for your work on the 2 really just critical issues that have been, you know, it's sore spots for mortgage lenders for so long, and just appreciate your doggedness on these issues. You ever see a word like Fannie, Freddie? Like I've been saying for years, I mean, would it make sense if they were maybe combined into one entity? Is that something you ever see happening, or would that make sense from an efficiency standpoint? And
how do you like the State Motor Vehicle Agency?
I don't.
I don't know. I don't know. One entity that provides a service that you have to get.
That's true. Great point, right? Keep each other honest.
We actually, I mean, a duopoly is not fabulous, I suppose, for choice and competition, but we sure think that having more than one gives our lenders options. And while in conservatorship, the competitive zeal between Fannie and Freddie has, of course, dissipated. And there are some times when FHFA says, no, you're going to be the same. We're going to have you unite on certain things. There's still ways they compete. And when they one day get out of conservatorship, they can go back to competing more directly for market share. And I think that's good for the system. I will say that in preparation for whatever comes in 2025, whichever way the election goes, if the administration changes and we have a Republican president, it's much more likely than it is if we have a second Biden term that there'll be some more interest around getting the GSEs out of conservatorship. So we have a board level task force now that's looking at all of our past GSE reform papers and positions, updating them for what's been taken care of, which there are some things like the uniform mortgage-backed security, for instance, and what the desired end state is, so that if there is a change and Treasury and FHFA start down this path again, and we believe still that it requires legislation to guarantee the securitizations of the GSEs. So we would have what we would hope would be considered the definitive blueprint for both Congress and the administration to follow. So nothing's going to happen in 2024 on this topic, but it's quite possible it could come back on the agenda in 2025, and we will be ready for that.
Can't see anything happening legislatively in housing right before the election. I mean, it's just nobody wants to help each other. It's, I mean, there's things I think the Biden administration can do without congressional approval, the Freddie Mac second mortgage thing being one of them. But is there any chance that anything legislatively gets done before November?
No. That'll save us some time. I could tell you why, but I think everybody knows why and where we are in the political process. No, there'll be very little non-mandatory legislation. Like we just saw the FAA reauthorization finally get done. They had to extend it a year last year. I mean, it only happens, I forget if it's every 5 or every 10 years, and they still had to give themselves a year extension. So nothing gets done in a time like this. And come, I don't know, Memorial Day or certainly the 4th of July, everybody's going to be back home campaigning, and it'll just be really mandatory stuff happening.
On to some other news, Bob. Recently, the Financial Stability Oversight Council released a report laying out their views on, some of the risks, the growth of non-bank mortgage servicing. Read your response to it, acknowledging, some of the growth in that sector, but perhaps alluding that maybe their analysis went a little too far. Maybe the bullet points on your thoughts on that report that came out.
Yeah, I mean, to me, the headline was what was not in the report. The Financial Stability Oversight Council, which is a group of federal regulators, and I think the state regulators have at least an advisory seat there as well. And it looks for ways, in the wake of the financial crisis, it looks for ways to see around the corner to avoid things like, remember how AIG structured products was something nobody had ever heard of, and suddenly the government had to bail them out, and there was really systemic contagion, financial contagion from that entity. So the idea of FSOC is to prevent things like that from happening again. So one thing they have looked at for years is the non-bank sector, and they focus more on the servicing side of it for this report. And as the rules that the member entities of FSOC, everything in Washington is supremely ironic. The rules written by FSOC members have driven many banks out of mortgage lending, right? The capital treatment on servicing is absurdly high. The Justice Department came after so many lenders for False Claims Act alleged violations that most got out of FHA and VA lending. And so as the government has driven out the depositories, of course, the IMBs come in. Thank God they came in. What would have happened if they hadn't? So the IMBs come in, and now they say, oh, geez, we're worried that too much lending is done by IMBs. And what happens if a big servicer fails? Well, frankly, what happens if a big servicer fails is it goes through the bankruptcy process, as we did with Ditech. And the employees don't vaporize the day you file for bankruptcy. You get debtor and protection financing, and life goes on, and the servicing is still worth whatever the servicing's worth, and then you keep it going until you have an orderly transfer. Well, okay, so they're worried about this, so they come out with this report, and a tool that FSOC has is that they could designate an entity or an activity as systemically important. And systemically important is a term of art that says we're going to have the Federal Reserve oversee this activity. Nobody wants that. They tried that with a few big insurance companies. One of them sold a bank to get out of it. One of them sued them and won to get out of it. And you could, but at least, you know, a huge multi-hundred-billion-dollar insurance company, at least you could understand why they might be concerned about that. Independent mortgage servicers, if one were to fail, explain to me the ripple effect and the systemic importance of that. I don't see it. At any rate, that's all a long windup to say this report said nothing about designating companies as systemically important, which is really crucial. And we are glad that that's the result. Now, you saw a bunch of other stuff in there, much of which would need congressional action. We just got done talking about how Congress doesn't do anything. So I don't think that, for instance, the proposal that there be an industry-funded pool of money that a failing servicer could draw on until the servicing were transferred, or some idea like that. And I guess some of these regulators think maybe that sounds a little bit like the FDIC, where member banks pay an assessment so that all of their deposits are guaranteed. Well, if you're a bank and you pay an assessment to the FDIC, you get to put a little sticker on the door that says your deposits are guaranteed up to $250,000 or whatever the limit is. That's worth something. And you can't compete as a depository without that seal of approval, right? No, who would put their money in a bank that's not FDIC approved? And there is no such benefit, at least that I can think of in the few days since this report has come out, that a non-bank servicer would get from paying into this fund. And in fact, if you were a really stable, secure, responsible non-bank servicer with lots of capital, lots of liquidity, seems like you'd be punished for paying into a fund that would help a weaker competitor get bailed out when they go down the tube. So I don't think that thing's going anywhere. I don't think it's a good idea, and I can't imagine that the Congress would pass that. Now, very briefly, there are a couple good things in the report. They said that they think the PTAP, which is a standby liquidity facility that Ginnie Mae administers, could be improved to be more to be used more often. Right now, there's some stigma if you use that program, and there's some thoughts that maybe there's some cross default problems, like you'd have to notify your warehouse lenders and stuff, and it could be a bad thing if you use it. So I agree, and I know Ginnie Mae agrees that that could be changed to make it more effective, and that and FSOC also urged Ginnie Mae to continue working with the industry on ways to make Ginnie Mae servicing less liquidity dependent. As you know, you got to advance on a Ginnie Mae loan whether the borrower pays or not until the loan liquidates and the house is sold. And New York, New Jersey, some of these judicial foreclosure states, that could be 3 years, and the servicer's paying the taxes and the insurance and the principal and interest, and it's a real liquidity drain. Unlike Fannie and Freddie, where you advance for 4 months and then they take it over. So we're working, and we have been working with Ginnie Mae for quite a while on various ideas, and we were heartened to see that FSOC is encouraging Ginnie to continue down that road.
This is The Big Picture. I'm Rich Swerbinsky, pleased to be joined this week by MBA President and CEO Bob Broeksmit. Just a few minutes left with Bob, but a couple quick kind of rapid fire questions. Bob, one thing you recently took umbrage with that I'm certain you'll bring up with Director Chopra and your back and forth in New York coming up next week is their statement by CFPB alluding that excessive junk fees from lenders are contributing to worsening housing affordability. What do you have prepared for the director for that back and forth?
Well, I gave a speech yesterday in Washington and touched on this at some length. It's frankly, it's appalling that, okay, we're in Washington, everything's political, it's election year, so everything's political times 10. But when you have the president in the State of the Union throw out this title pilot at Fannie Mae and say, I'm going to save home buyers $1,500 when they close, and you dust off a pilot that had previously been rejected that is only for low risk rate and term refinances, I said to the White House, that's great. We're going to do 6 of those loans this year as an industry. I mean, come on. It's just ridiculous. So then the next day, the Bureau puts out our favorite way of being regulated, a blog post that says, we are shocked that the use of discount points rose rapidly from 2021 to 2022. What else rose rapidly from 2021 to 2022? Interest rates. If you can get a 3% loan with no points in 2021, why in the world would you pay discount points? If it's 6% in 2022, you might say, well, geez, I'll pay a point so I can get 5.5. I mean, come on. Our response, we've never written a response like this, says, this regulator doesn't even understand the industry it purports to regulate. And that was just on discount points. Then they said appraisals and credit reports and flood certs and title are all junk fees. And we said, well, the administration's own definition of a junk fee is that it's not disclosed to the consumer. Not only are all these fees disclosed to the consumer early in the process, they are disclosed to the consumer on forms promulgated by the very bureau that's now calling them junk fees. So this is just, Alice in Wonderland nonsense. And we'll keep reminding the Bureau that there's a lot of fish to fry if you're trying to protect consumers. And I think we all hate the pick the seats for the concert and then you go to the checkout thing and suddenly they're twice as expensive as you thought they were because the fee really isn't disclosed until you get to the last page of the, okay, great, spend your time on that. Don't spend your time trying to re-regulate something that you have written the rules for and enforced the rules for, and we spend zillions of dollars a year complying with, and then accuse us of charging junk fees, which just undermines the consumer's confidence in the mortgage industry. So that one, as you can tell, gets me a little wound up.
Going back to nothing getting done in Congress before the election, no chance, right, that Alanna McCargo, Marcia Fudge are permanently replaced before November, right? I mean, I can't see that, but maybe?
Yeah, I think it's an interesting question for the Biden administration. I think that if, as one maybe symbolic, but I think important indication of how committed you are to housing, you probably ought to at least appoint a HUD secretary, and whether the Senate gets around to it, I mean, that's up to the Senate. But so I don't know. We have a good relationship with Acting Secretary Todman, who was Deputy Secretary before under Secretary Fudge, and she would, of course, would be the logical candidate to be nominated for to be full HUD secretary. The good news is because she's already Senate confirmed and in place at HUD, she has all the power of a secretary. But I do think it would send an important signal to have a nominated HUD secretary. And again, it's up to the Senate on how long it would take to hold a hearing. I don't think it'd be particularly controversial, but you know what a premium committee hearings and floor time are at in the Senate. So who knows whether it would get over the finish line. On the Ginnie Mae side, your guess is as good as mine. Sam Valverde has been in place at Ginnie in a senior position for several years. We have a good relationship with him as well. Again, he'll be speaking in New York at secondary, and we will continue to work closely with him, whether he is nominated and confirmed or whether he remains as the acting president.
Can you ever remember a presidential election in all your time in the industry that would send the industry down two more dramatically different paths, given just the heightened importance with Americans of housing and housing issues right now?
Well, it's a good point, Rich, and it is an artifact of these recent court cases that said we're not so sure the construct of the Bureau with a single director and FHFA with a single director who cannot be removed by the president except for cause. We're not so sure that's constitutional. So the court said, but if you made them removable without cause, in other words, serving at the pleasure of the president, then it's fine. And so that's what we have, as opposed to, say, a 5-year term that might bridge presidential terms. That's out the window now. I mean, I think they still have the term, but when the new president comes in, they can do whatever they want. And so FHFA and CFPB feel a lot less like independent regulatory bodies as much as instruments of the administration. So that one result of that is that we do have very significant pendulum shifts depending on who's in the White House. So all that to say, I agree with your point that this presidential election will be very consequential for housing policy, particularly at a time when the general expectation is that the House and Senate, whichever way they go, some people say Republican Senate and Democratic House is the most likely outcome, but it could be anything. Whatever it is, I think it's safe to say neither party will have a strong majority. So legislation will continue to be very difficult. So most of the action will be in the administrative and regulatory agencies. So who appoints the FHFA and the CFPB directors is really consequential.
Swinging things back to the positive before we take this home, Bob, MBA Open Doors Foundation, the outstanding philanthropic arm of MBA for decades, done so much incredible work that just can't even really be measured. Give us an update on the latest with Open Doors and what you're into with that foundation.
Sure. MBA Opens Doors is our way of giving back in a way that is really directly related to what we do every day. ODF, as we call it, makes the payment for families who have kids in children's hospitals across the country. We have 13 partner hospitals. And so we give grants that equal a month's rent or a month's mortgage payment, depending on the setup of the individual family, so that parents aren't faced with the choice of missing work and or being by their kid's side. They can have the peace of mind that their housing payment is taken care of so that they can focus where they need to, which is getting their sick kid better. And we have just tremendous support from MBA membership, both at the corporate level and many and a growing list of individual donors who really see this as an extension of what we do every day. And Deb Dubois is the president of ODF, and Deb Still is the board chair from Pulte out in Colorado. They do a remarkable job, and we thank everybody who has been so supportive of ODF and encourage you to look on MBA's website under ODF or MBA Opens Doors, and you will find more information about how you can be part of the great satisfaction we all get out of that great cause.
Love it. And then lastly, earlier in the show, you mentioned a number of different ways, just people to get involved. Have been amping up my messaging on this just because of the importance of just voices in our industry to help educate and inform, those that are making decisions that affect it. You mentioned, talking to your local politicians and the power of them hearing from local constituents. All the different ways to get involved with MBA. You mentioned the Mortgage Action Alliance. It's so easy to get involved with MA, and such a low lift for maybe that individual that is passionate about our industry, wants to give back in their own way, maybe doesn't have gobs of time to do it. But tell the audience a little bit about just how easy it is to get involved with MA.
Sure, and more importantly, it's free. The Mortgage Action Alliance is our free grassroots network that helps activate the industry's voice when there are important things being considered, not only in Washington, by the way, but also in the state houses, because as you see less being done in Washington, sometimes states get pretty active and they might pass state level laws that can be either that we want to encourage them to do, like remote online notarization, or that we think would be a bad idea. And if you sign up, which is easy, check out MAA or MA, Mortgage Action Alliance, on our website. You can then get alerts when we have an issue. And I mentioned trigger leads earlier. This is an outstanding what we call to action, which simply means that you get an email and you click on something, and there are letters pre-written to your representative in Congress and your 2 senators, or if it's a state issue, to your state representatives. And if you want to, this is completely voluntary, you can go in and customize them and say something about yourself or your company. More often, people just say, I'm going to trust the people at MBA that they've written this letter in an appropriate way. And you just click send. And the whole process is about 30 seconds. And in this era where snail mail is kind of out the window, and if you write a handwritten letter to somebody in the house, it's got to go through an elaborate security system. Remember all the ricin and crazy anthrax stuff we had back whenever that was. So it's really not effective to write a handwritten letter, but email, of course, is the coin of the realm, and it's an easy way to do it through the Mortgage Action Alliance. So we really would encourage you to join the more than 70,000 other mortgage practitioners who are part of MA and have your voice heard.
Even Rob said he was able to figure it out. So it was really the truth. I mean, so very easy and effective way to get involved and have your voice heard. And but Bob, want to just thank you for, as always, agreeing to come on, being so forthright, so insightful, and supplying our viewers and listeners with so much just great intel about all the things that have been occupying your time lately. Stakes are high right now. Would argue is, if ever, a time to get a little bit more involved in the industry. This would be it. And just want to thank you again for your time today.
My pleasure, Rich, and make sure you sell your shares in whatever company Chrisman's on the board of.
It's a good reminder to all. So last, I just want to thank our attendees and those of you that are watching on YouTube or listening on podcasts. This is The Big Picture. Next week, Bill Dallas will be joining us Thursday, 3 p.m. Eastern. Looking forward to getting caught up with Bill, seeing what's going on in his world. And once again, I want to thank MBA President and CEO Bob Broeksmit for his time today. Thank you very much, Bob, and thank you to our attendees. Have a great.
All right, Rich, thanks a million. Take care.
All right, take care, everyone. Have a great afternoon.